The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to this Wednesday edition of Squawk Box with Karen Cho and myself, Steve Sedgwick. And these are your headlines. The Nasdaq posting its fifth straight day down, with the likes of Nvidia and Meta weighing the index down. Attention, though, of course, now turning to the absolutely pivotal inflation data. Yes, it's CPI report time. This after actually better than expected producer price data. South Korean police arrest impeached President Yoon Suk Yeol at the second attempt, making him the country's first leader to be arrested in office.
French Prime Minister Francois Bayrou pledges to reopen talks on President Macron's pension reforms in a bid to win over left-wing lawmakers ahead of a vote on the country's budget. And UK Chancellor Rachel Reeves tells lawmakers she is committed to her October budget, standing defiant as she responds to concerns over the rise in borrowing costs.
There's been a global volatility in markets. I don't believe that it is reasonable to suggest that the reason why bond yields in the United States, in Germany and France have risen is because of decisions made by this government. I think the honourable member opposite should just get real.
Good morning, Karen Cho. How are you?
Very well, thank you.
I am rubbish at chess.
Right.
but this feels like a chess game at the moment, doesn't it? It feels like, okay, so if the PPI does this, then the market's going to do that. But then we're expecting three moves further on to try and work out the reaction to, is it the headline core CPI or the core or this component or this component? And I felt yesterday was fascinating. And certain pieces moved where I expected them to move on the back of a pretty tame PPI. But the Nasdaq didn't, and it was those two names that I mentioned in the headlines. It was a great headline. It encapsulated everything I wanted to say. That what is going on? Now, you and I are two, I was going to say long in the tooth. You are not long in the tooth, but we've been around too long to think, okay, 5 down days for the Nasdaq, that's it. It's a massive rotation. But it's beginning to look like something now, isn't it? With Nvidia and Meta selling off, despite the fact that we had exactly the data on day one, on the hors d'oeuvre day of inflation that the market wanted. Of course, today, we're going to shove aside the canopies because today, it's all about CPI.
Well, a couple of thoughts here. It was unconvincing, the market move yesterday. I mean, the Dow had a little bit of movement, but elsewhere it was very timid. And in fact, there was a give back on the technology indices. So it's telling me that even though we had a tame PPI, the market was unconvinced at this point that it's time to dip a toe in the water. Now, I started out the day thinking, are we peak Nvidia? Because this is the way the market is treating Nvidia at this stage. They're concerned about the valuation. They're concerned about whether there's too much now priced into the stock. Do we actually believe that we're peak Nvidia? And I think there are comparisons out there in the marketplace. If you look back 5 years on Amazon, where the stock was, that there were more price gains ahead, even though it had a very full valuation at the time. So it feels as though nobody wants to take another morsel of some of these highly prized stocks until there's more convincing evidence that they should do so.
Well, I think you've raised a lot of questions, and I know you're going to go look at the walls here, but just as you make your way to the markets, I would just add one thing, and that is, if we're peak Nvidia, which actually isn't a terribly expensive valuation compared with some other tech names out there, this is a company that's churning off cash and free cash flow. What does that mean for all those other AI stocks that aren't churning off cash, that are achieving huge valuations in funding rounds in the private market, Karen, and people are getting excited about in the public markets as well? If Nvidia, which is the benchmark, delivering vast amounts of real money, real profits, what does it mean for all those other companies who aren't making money, but they just put AI at the end of their company?
Well, the problem with Nvidia is that it is such a market heavyweight these days in terms of the market cap of this company. So if it doesn't move to the upside, it traps the fortunes of some of the major indices. If it moves to the downside, it has a disproportionate effect too. So on markets yesterday, with that Nvidia lag effect, you saw the S&P 500 barely getting going, up about 0.1%. The Nasdaq actually pulled lower by that sinking effect of Nvidia. The Dow, immune to some of those challenges, rising 0.5%. If you look at the various different plays on the market, we were talking yesterday about whether we were getting an element of rotation in this market, and thanks to the data yesterday, that seemed to be encouraged further. Caterpillar still one of the biggest movers for the likes of the Dow, so somewhat of a cyclical move there. And if you looked at the sectors that were also driving the trade yesterday, it was utilities to the upside, clear outlier up 1.3%, but communication services, where those big tech names are housed, they were down to the tune of 1%. Another big feature here, we are on the cusp of earnings season, so banks in play too is where we count down to today's session. Now, we mentioned the data. It was about the PPI. Today, it's about the CPI, a different end of the spectrum on the inflation side, from the factory gate to consumers. But if we take a look at treasuries and how they're reacting, you can see the 2-year, we're 4.36%. But if the CPI comes in hot today, there is a view that, look, we start marching back towards that 5% handle on the 10-year. So we're closely watching the 4.77% that we've got on the 10-year Treasury yield today as we regroup for another hit on inflation numbers. The dollar as well. In this context, it's been a dollar is king story. Euro-dollar this morning just giving back a little bit of territory, although there was a little bit of an improvement on the euro-dollar trade, as you can see, enough so to get us closer to the 103 handle, even with some give back this morning. Cable 122 flat, as you can see, but that is down a 10% morning session. Dollar yen 157.28, 4/10 down. So there is somewhat of a decline there. To the Asian markets, and we've got Hong Kong inching ahead. Elsewhere, modest declines taking place. The South Korean market, we're closely watching again around the politics, and that is, again, a slightly different story versus the rest of the region. Steve?
We've got a great guest waiting in the wings, so we'll get to him after these next couple of reads, just to fill in a couple more gaps. So, as we mentioned, US producer price inflation rose 0.2 in December. That is half the Dow Jones estimate and November's reading. Headline producer price inflation, though, still came in at 3.3% on the year, triple the reading that we had this time a year ago. So hotter than a year ago. Lots of mitigating factors, though. But as I say, that's the canapé. Today we get the main course. Today we get your steak and chips, or if you're a vegan, your nut loaf and chips. This ahead of today's all-important CPI print, the last month or full month of inflation data under President Biden. Consumer price inflation is expected to come in at 0.3% higher on the month in December. That is the same as in November, though the yearly figure is expected to tick 20 basis points higher to 2.9%, according to Dow Jones estimates. George Lagarius is Chief Economist at Forvis Mazars. Sir, thank you very much indeed for joining us. It's lovely to see you, as ever. Here's my question, and I've been pontificating in my own brain about this. Given that the Federal Reserve and the market is already expecting pretty much zip in terms of rate cuts in the first half of the year, is today's CPI as exciting as I'm thinking it is in my own head?
Honestly, at least for me, not that much. I think all the data that we're seeing, yesterday's PPI, today's CPI, are by and large a little bit irrelevant. You know, they tell a story of inflation stuck somewhere between north of 2.5%. And part of it is oil, right? Because it's up 13% since the beginning of the year. But the point is, and what we're looking at right now is, what is Mr. Trump going to do with his trade wars and his tariffs? Where we are in inflation today is just a basis for what is to come. And this probably is the last or the penultimate piece of data from a previous era. And then we usher a new era in the next couple of months.
George, I'm really disappointed you say it's a little bit irrelevant, but I think something you said afterwards actually makes it not irrelevant. Let me go with it. You said, yeah, but this is the basis of inflation level that Trump's going to inherit. Trump knows that he wants the stock market to go up. It's actually one of his key performance indicators, like mine is trying to keep viewers rather than losing viewers. And one of his is the stock market. If the stock market sees CPI, which is too hot, which means that Trump policies will invigorate that inflation more to the upside, then surely it's important, not necessarily for what the Fed's going to do in the first quarter, but certainly what Trump's going to do in the first quarter.
Well, that would assume that the incoming president is responsive to macroeconomic data and by and large to advice. So, you know, I would not care to speculate on that one way or another. But what I say, the story up to now is that Mr. Trump inherits slightly elevated inflation. And on top of that, He's considering tariffs from day one. This is, this is the very simple narrative. And that narrative is inflationary, and the central banks know it, and the markets know it, and they're already beginning to price in even rate hikes. Some of the traders. So the story is one of inflation with upside risks. That's why I'm not too much focusing on whether inflation today is going to be 2.9, 2.8, 3%. Traders might react, but the slow money, the dumb money like me, will take it will take a lot more time to see what's happening. Okay, and you need to be sluggish to react. You need to be reactive in this market. Proactive is for traders. For slow money, for big money, that is, you need to wait and see.
George, just give us a sense of how unusual it is to have these types of scenarios for a central bank to be in accommodative mode, neutral mode, tightening mode, all at once, potentially in 1 year.
Well, it's not easy. Yes, we entered the year, you're right. We entered the year in a sort of accommodative mode. We're still expecting, markets are still pricing in a median one rate cut. But you see a lot of traders out there pricing in a rate hike, and a lot of the market just on the sideline and waiting and pricing in zero. It all depends on the attitude of the new administration. That's the big question mark with which we enter the year. And simply put, we cannot predict, we cannot forecast this, okay? Because some of it might be rhetoric, some of it might be threats that will never come to pass, and some of it might be actual tariff intentions. What we do know is that tariffs are inherently inflationary and also the disruptive to global supply chains. Okay, there are some mitigating factors, macroeconomic factors going forward, but by and large, Mr. Trump's attitude towards tariffs will determine inflation, and he's not in office yet.
George, on that note, the latest news flow that we have to work with is whether the tariffs could be introduced slowly, start to be ratcheted up from a lower level. Some of the quarters of the markets, namely Asia, took this as a positive sign. Any win on the tariff front, that seems to be away from the harshest view of a higher tariff imposed automatically. But what would the economic consequence be of a slow introduction of tariffs?
More market uncertainty, I would suppose, because you say we start slow, but that means a start. In terms of market, I would like to know where they're taking this. If they're doing this, okay, let's start you off slowly, and if you don't comply, we'll increase tariffs. That is the actual beginning of a trade war. It is the first moves in a chess game. Okay, but going forward, that chess game has moves and counter moves. So slow tariffs mean many moves and counter moves, which means more market uncertainty. Fast tariffs, at the very least, would allow for one move and one counter move, and we keep it at that. And at least markets would know where they are, what their stepping stone is. So personally speaking, I like more certainty. Even if it means higher tariffs, at least we will know.
George, which brings us back to the bond market. I spent a lot of time the last few days trying to explain to people, I think that's where it's at. I don't think it's in the equity market. I think the bond market has historically been the canary in the coal mine for the stock market as well. The tensions in the underlying bond market, are they at any kind of level where actually the equity market is being too glib, or actually are you quite comfortable with the levels we're seeing, 4.7, 4.8% in the underlying treasuries?
I am not. I think the bond market has been convulsing consistently since September. And we've already seen, political repercussions. We're already seeing budgets derailed because of that. So I'm not. The bond market is really where the action is. And as you very well put it, stock markets generally should follow. And the bond markets are increasingly uneasy with the inflation narrative and with the potential disruption in global trade, and also with all the issuance of bonds coming up. And yes, equity markets, well, Magnificent Seven managed to ignore bond markets between September and December, but they cannot keep doing this forever. So, no, I think equity markets will likely follow bond markets in this particular instance. Bond markets know exactly why they're nervous.
George,
we were entering disinflation, and now we're talking inflation.
George, it's really important what you just said, and I want to get this absolutely right. Either the yields come off or the stock market has a serious correction, yeah?
Let me put it another way, because I can't predict the future. Either the yields come off or I wouldn't increase risk for my own portfolios.
Wow. George, lovely. By the way, are you holding your camera?
Just a little bit technical.
Do you know, I might send you, I might buy you one of those little tripods. It's much easier, my friend. You look great anyway, but I wouldn't give up the job as a chief economist to be a cameraman. Just saying for a friend. Lovely to see you, George. Thank you.
Thank you.
George Vegarius, chief economist at Forvis Mazars. I hope he takes that in good spirit.
Hey, you don't even recall how hard this was. We were at home, we were broadcasting.
Yeah. And do you know what? CNBC sent me a blooming great tripod.
Yeah.
But the fun thing was...
The tripod was the least of the issues, I've got to say.
Oh, man, do you know...
the Wi-Fi, I mean,
Well, yes, yeah. You know that you should have the countryside Wi-Fi. But the funny thing was as well is when George, or one of the team in the gallery said, "Oh, can you just change the headroom a little bit?" So you think you're perfectly set, and then because you can't have a viewer on the front of your camera, so you're having to kind of get up, move it, and they go, no, left a bit, and it just took forever.
Yeah, and then the focus when you're meant to be behind the camera doing a focus, and then you're sitting in the chair doing the focus. It's hard work, isn't it?
Next week, CNBC will be live from the Swiss Alps in Davos. I hope we'll be live anyway. We'll be speaking to top policymakers and business leaders, including conversations with the new EU competition chief, Teresa Ribera, the EBRD president, Odile Renaud-Bassot, Poland's finance minister, and the IMF first deputy MD, that's Gita Gopinath. We'll also hear from the Dutch Prime Minister, SAP CEO Christian Klein, BBVA chair Carlos Torres Villa. It all kicks off on Tuesday, direct from Davos, across CNBC TV and online, and all live on the CNBC International News YouTube page.
We've already got the thermals out here, so we'll just roll on to Switzerland for next week. Well, BlackRock executive Mark Weidman is reportedly leaving the company after more than 20 years. That's according to a source familiar with the matter who spoke to CNBC. Weidman was long believed to be a potential successor to CEO Larry Fink and was instrumental in driving BlackRock's growth in passive investment. Meanwhile, JP Morgan Chase announced its chief operating officer, Daniel Pinto, will step down in coming months. The bank said he will give up his COO and president roles in June and retire at the end of 2026. Major US lenders are set to kick off earnings season stateside this week, with JP Morgan, Goldman Sachs, Wells Fargo and Citigroup all set to report before the bell today. Investors largely expect to see a surge in profits after the last 2 months of the year saw a jump in trading activity following Donald Trump's election victory. Leslie Picker filed this report.
Bank stocks have really come full circle since their post-election glow when the prospect of deregulation sent the sector soaring, and even as gravity has taken hold in recent weeks, looser capital requirements and what they mean for buybacks remain an open question. Goldman Sachs estimates there's about $185 billion in excess capital, some of which could be returned to shareholders if banks were required to hold less of a buffer against a shock. Because over the last year plus, banks have really been hoarding capital despite a stronger economy due to the expected hike from those proposed Basel III capital rules. Under the new administration, though, the incoming administration, and with pending turnover in the Fed's supervisory role, it's highly likely that new rules will be far less onerous for the banks. As a result, Goldman says the industry could repurchase 4.5% of its market cap in 2025. The firm estimates that banks will have $90 billion in excess capital if Basel III were to be just 50% as tough as originally proposed. And the firm says JP Morgan, PNC, and U.S. Bank have the highest capacity for that capital return. For CNBC Business News, I'm Leslie Picker.
Coming up on the show, South Korean police storm the presidential residence, finally arresting the country's impeached leader, Yoon Suk Yeol. We'll bring you the latest. Plus, the UK economy and Chancellor Rachel Reeves face their next big test this morning with the release of December's inflation print. We'll break those numbers at 7 GMT. And we'll be speaking to the founder and CEO of one of Europe's key AI names. Don't miss our conversation with DeepL's Jarek Kutilowski. That's at 7:30 GMT. South Korea's impeached President Yoon Suk Yeol has been arrested at the second attempt after 3,000 police officers helped secure access to the presidential residence. It follows his short-lived martial law decree and subsequent impeachment. And let's get out to Sherry for more. She joins us from Hong Kong. Sherry, this is a story we've been following, and now, of course, authorities having about 48 hours to come up with a decision whether they want to detain for up to 20 days or release the president. But what strikes me is that there's been a lot of Trump in this story, despite being so far away. Parallels, even though very different circumstances, to the insurrection, but also some calls from South Koreans for Trump to somehow lend his support. Just talk us through some of the support base and what authorities do now.
Yeah, and what you probably saw is among Yoon's supporters who've been really camping out outside presidential residence, holding the signs that say "Stop the Steal." And of course, this is really one example of global diffusion of Trumpism. I do the quotation marks because those are words coming from one of the guests that we had on during Asia programming just a few days ago. So yes, Yoon's supporters definitely think that this is a part of the election rigging process. So basically, Yoon needed the martial law about a month ago in order to really look into the election rigging allegations. Of course, these allegations are not substantiated as of yet. Today's headline, though, Karen, is Yoon arrested. He's not talking. Although he did record this public address right before he moved to the investigation office, cooperating with the investigators who wanted to arrest him. Take a listen to what he had to say.
Unfortunately, the law in this country has completely collapsed. I cannot help but feel deeply dismayed as I witnessed a court without proper jurisdiction reviewing warrants and issuing arrest and search warrants to an agency that does not have investigative power. I witnessed the investigative agency committing illegal actions by deceiving the public, by issuing false official documents and forcibly executing the invalid warrants.
So he sounds very defiant at the moment. He said that he's showing up for the questioning by the investigators just so that he can prevent any kind of physical clashes, any bloodshed because of the standoff. It's really the optics of an incumbent president being arrested. It could actually make him look already guilty. I think that is really the thinking that goes through the supporters as well as anti-Yoon protesters as well. But if you look at the recent opinion polls, quite fascinating how Yoon's as well as his party's approval rating has been rebounding pretty sharply as well, still below the support rating for the oppositions. I think it's really showing how conservatives in South Korea are consolidating. They may not be on board with the idea of martial law. They may still think that he should be impeached, but they're not actually giving support to the other side, the progressives in the country, because post-martial law politics in South Korea has been just too messy, too destabilizing. And of course, the main opposition has been impeaching the president, the acting president, threatened to impeach the next acting president as well. So I think all this really shows the political fatigue. We'll see how things go on the constitutional side of things as well, because the second hearing for his impeachment trial is scheduled for tomorrow. Can he take a break from the questioning and to show up for the court is another question as well. Guys?
Sherry, the story that's been unfolding really tests the narrative of modern-day democracy. What's the impact been on South Korean assets? Because I know the stock market, the Kospi, has been falling over the course of the last number of months, I should say. So what exactly is the bid-off level when it comes to South Korea?
It's quite interesting. So far this year, have you noticed that Kospi is actually the outperformer in the Asian region? So it is up just about 4% or so, but it's really the low valuation story that foreign investors have been holding on to. If you like getting into South Korean markets, that has been really the story. In the month of December, so that is the month that we saw the martial law and impeachment and this cabinet looking very thin by day, that's when foreign investors sold off Korean assets, bonds, stocks, and if anything, we did see a jobs creation also getting a hit, and the bank lendings to households also took a hit. So I think all that activities really just came to a pause in the month of December, but that's actually picking up a little bit, at least for the first 2 weeks of 2025.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.